everyone, and welcome to the Final Bar. It's Thursday, May 9th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com today from a beautifully sunny and warm Redmond, Washington. Today we're going to talk about the market having a nice update. The S&P and the Nasdaq finishing much higher, but not with the leadership you might expect. Real estate, utilities, energy, materials, those are your top four sectors. The growth sectors are at the bottom of the list today. Let's look at all those charts and many more as we get to our market recap. So here we go, looking at the major equity averages. You can see all in the green on page one, except for the VIX. The VIX is the only one that actually was in the red, and that's been really the mark of this recent market move, right off of the swing low last month in April. You've had equities going higher. You've had rates coming down because bonds have been going up as well. Volatility has come down. Spreads have come in. It's very much been a risk-on environment over the last 2 to 3 weeks, and we're continuing to see more of that. We'll get to the sectors here in a minute, but digging into the major equity averages, you can see that the Dow, the S&P, the Nasdaq, all in the green. The S&P 500 finished about 0.5% higher, closed around 52.14. The Dow getting closer to 40K, didn't quite make it up there today. 39,388, we'll call it 0.9% higher. The Nasdaq Composite was up about 0.33%. The Nasdaq 100 up a little less. So think about that, right? In order of performance, you have Dow, then S&P, then Nasdaq Composite, then Nasdaq 100. So the mega cap growth trade lagging behind in a pretty decent way on a day like today. Mid caps and small caps both up about 1% for the day and outperforming the S&P handily. The VIX, down below 13 now, and this is the first day. We'll have to look at the chart in a minute or two here, because I don't know the last time it's been below 13, but it's been a little while since we've gotten down to this point. So again, VIX below 15 for me means like no red flag. It's sort of a nice, consistent uptrend, and in my experience, you wait for volatility to spike, and it usually behooves investors to just be patient in this sort of move, respect the short-term uptrend, and look for the signs that that uptrend is over. We'll get a chart of the S&P here in a minute because it's an interesting one. That bull flag pattern, or bear flag pattern we've been talking about, I don't think that's the pattern. I think I'm ready to. I actually did remove it from my chart yesterday as I was talking to folks at the Money Show in San Francisco. Interest rates all coming off through the course of the day today. You can see the 10-year yield really just rotated lower as bond prices went higher. The TLT finished up about 0.5%. That's a bond ETF. And when bond prices are going up, that means yields are coming down. So the 10-year yield down to around 4.45, almost the same as the 5-year point. Those two have been very similar here for quite some time. The long bond a little bit higher at 4.6%. The short end of the curve, of course, still above 5%. So we still have that inverted yield curve, and the dollar was down about 0.33% today. Looking at the commodity space, gold and silver, boy, another decent update. We'll look at gold stocks here in a little bit. Time permitting, because the charts of gold and gold-related things look pretty good. It was one of the takeaways I had from the Money Show. I had a number of great conversations with some of the other speakers, a number of the attendees, just about where their head was at with the market environment. And talked to a number of ETF providers, the folks from InfraCap, the folks from Granite Shares, talked about commodities and really gold prices. A reminder that gold has outperformed the S&P and the Nasdaq year to date, and that is still true to this day. The GLD was up 1.6%. Silver prices up almost 4%. Crude oil, copper prices all in the green as well. Looking at the crypto space, kind of hanging in there, right? Bitcoin around 62,478, that is, and that's up about 2%. Ether prices back above 3K, dipped below there over the last 24 hours, kind of pushing back above there, up about 1.5%. All 10 of the top coins that we track on our platform, all in the green. Looking at the sectors, I think this is fascinating. If I told you before today the S&P, the Nasdaq, the Dow were all going to be in the green, what sectors are at the top of the list, you would probably guess something like technology or communication services, maybe consumer or something like that. Those are your three bottom performing sectors today. They all lagged behind the Dow for sure. The consumer discretionary kind of got it done, but the biggest sectors were down at the bottom of the list. Your top of the list items, your top four, are real estate up 2.4%, utilities up 1.5%, energy up 1.3%, materials up 1.1%. So you have a mix of defensive sectors like REITs and UTs. You have cyclical leadership like energy, materials, and industrials, what we call the MEI trade, materials, energy, industrials. These are the opposite of growth stocks. These more value-oriented sectors, different type of leadership, but certainly showing strength. The REITs have been underperforming for quite some time, so that's actually new, but utilities have been the top sector the last two sessions and many sessions in the last couple of weeks, so you're really seeing utilities improve on a relative basis. Your bottom three sectors are your three FANG sectors. Tech was flat for the day. Communication services up 0.5%. Consumer discretionary up 0.7%. Our market trend model remains bullish on all time frames. No real change there. And again, we'll update that formally as of Friday's close, but for today, no real change to that general thesis. Look at the mega cap growth leadership names and note that stocks like Tesla down. On an up day for stocks, Tesla was down 1.6%. On an up day for the major averages, NVIDIA was down 1.8%. You have Apple and Amazon both up about 1%, but some of these mega cap names that you would think of as being leadership, not getting it done. By the way, top performing industry groups, which don't talk about too much, were in REITs and materials, right? The mining and gold mining stocks getting it done more than anything else. Let's go to a daily chart of the S&P 500 and see how things played out through the session today. I have officially removed that bear flag pattern because it just doesn't look like one anymore. And as we talked about, I don't think that's a failure of pattern analysis. That's actually, in my opinion, using it correctly. As I've tried to reinforce many times, anytime you have a price pattern, like a flag pattern, like a head and shoulders pattern, a cup and handle pattern, a triangle pattern, whatever it is, there are three parts to that. Step one, the setup, which means it starts to look like the pattern. And I think we had that with a potential bear flag pattern. And at that point, you have to actually technically label it as a potential pattern. That's what we were taught in the CMT program. You actually can't formally call it a bear flag pattern until you get to step two, which is the trigger, right? Every pattern has a level or a signal that would generate that actual trade, right, or would generate the signal. Until then, it's just maybe a bear flag pattern. Until you actually do the trigger, it's not valid yet. It's not a valid pattern yet. So we never got that validation, which is a break below trendline support. And then the third step, by the way, is called a confirmation or a follow through, right? An additional move in that same direction. So we never really got the rest of that. And I would say now that we've gapped higher and just continue to move higher, we're almost above the upper end of that bear flag. It just doesn't look like a sort of classic bear flag pattern anymore. It looks like something different. So I'm taking that label off. I left this trend line on because I think it's still an important one to watch. And I think when we break down below a trend line like this, I think that could be pretty bearish, but it's not happening today. I've highlighted in orange, by the way, just to make this comparison, because when we have this rally, which, in some ways very much feels like a counter-trend rally, in a day like today when it's defensive sectors leading the way higher, it still does not feel like an all clear, the markets are great here. It still feels like a leadership rotation and, something that tends to happen more at market tops when those sectors start to thrive at the end of the bull cycle. But if you look at July, August into September of last year, we made the new high in July around 4,600. We pulled back below the 50-day moving average. We went briefly above the 50-day in late August, and that ended up being a lower high, and the RSI never really got above 60. We're kind of right at that exact point here where we could be making a lower high. Now, the RSI is starting to diverge a bit from what we saw at the end of August. The end of August, the RSI never got above 60. You actually did get that today with the RSI finally closing above 61. So, really close to where I think that doesn't look like the August peak anymore, but we're kind of right there. And I think going through tomorrow into next week, that's my question is, do we, have another failure? Breaking below the 50-day, I think would validate very much a likely September kind of scenario repeating May into June. So we'll see, right? Lower high on weaker momentum is usually not a great look for the S&P. Remains to be seen, I would say. doing a briefly look at a breadth indicator or two. I mean, as you could probably guess, a lot of the breadth indicators are quite strong. This is the McClellan Oscillator, not yet updated for Thursday's close, but most likely pushes a bit higher given the number of stocks that were up today. Just the raw advanced decline data was very much favoring advancers over decliners, and a lot of stocks were going up today. And so as a result, the McClellan Oscillator really gave a kind of a weird, choppy buy signal, but I technically would call it that last week in April where we finally pushed above the zero level for a couple days, and certainly looks like that is confirming further upside. Look at the stocks above their 50-day moving average, which is now back above 50%. I think that's actually one of the more bullish rotations that we've seen. The S&P getting back above its 50-day. Now more than half of the S&P members are back above their 50-day moving average. That is a bullish configuration. The long-term breadth, of course, has remained quite strong. So, 3 out of every 4, a little more than that, S&P members are above their 200-day moving average. That really didn't budge too much. Never really got below 70%. So really suggested that the long-term breadth was more constructive. Last breadth chart I'll show you, and then we'll get to some other ones, is looking at the new 52-week highs. I think one of the more encouraging developments I've seen over the last week is that more and more S&P members, more and more NYSE listings are making new 52-week highs. Even though the S&P is still below its 52-week high, we'd have to get above 5250 to do that. This tells you that a bunch of other stocks are already eclipsing that previous swing high, maybe from late March, early April. So those early leadership names are already getting it done. As a matter of fact, as of today's close, about 10% of the S&P members made a new 52-week high today. So you are seeing some of those early leaders pushing the way higher. I think that's a more constructive look than we've seen anywhere. And again, the biggest question mark I would have is how strong can our benchmarks go from here if the breadth is positive, but the mega cap growth names that are the biggest weights are not really thriving as much as you might expect. And I think that's a very real scenario that may indeed be playing out here. Now, if you ask about why the markets are doing so well, why do you see the strength that we've been observing, I would argue a big part of that is because of the interest rate environment. When we look at the 10-year yield, you can see it's been coming down. It's down again today. We're on 4.45. A couple weeks ago, we were sitting right around 4.7%. So interest rates are coming down, and that coincides perfectly with the rally that we've seen in equities, right? So when rates are coming down, that's sort of that signal that sort of suggests that it's going to be a more hospitable environment for stocks. That means most likely that's better for the consumer. That's what exiting this or sort of beginning this Fed tightening cycle most likely brings the 10-year yield down a bit until we get to that optimistic economic outlook when rates would start to go higher a little bit. But, rates went up essentially because of the Fed trying to, restrict on the short end of the curve and restrict consumer activity to make things more expensive, to slow down the economy. They've made it very clear that is something that they are looking to do. But in the last couple of weeks, the rates have moved against that, and you're seeing the 10-year yield come down. So as long as the 10-year yield keeps going lower, I would say that's a great opportunity for risk assets to continue popping. What concerns me is, I think we mentioned on yesterday's show, we're entering sort of a confluence of support. Actually, 10-year yield found resistance around 430, 435 here in February and March. We're kind of getting near those levels. We have a confluence of moving average support right around that point. The chart of the TLT, which is essentially this upside down, has moving average resistance to contend with. So I'm concerned about the further upside for stocks unless rates continue to go lower. Now, one thing that is definitely going up more and more, gold stocks. We highlighted on yesterday's show names like Kinross, KGC making new 52-week highs. Kinross was on earnings, but a lot of gold stocks starting to pop higher. The GDX, which is a gold miner ETF, really, I think at this point breaking out of what you would call a pennant pattern, sort of like a little coil pattern or a symmetrical triangle pattern. This is what it kind of looks like if you're not familiar with that particular pattern. You have a run higher, although it could come after a downtrend, to be clear. And then you have this little pattern here, and I'm quickly drawing it for time, but you get the idea, right? Lower highs, higher lows. So after an uptrend, we're consolidating. And this is the market for about a month, settling into an equilibrium right around $34 a share. So this is basically saying gold stocks are worth about this much. and you wait to see where it breaks, because at some point the pattern's going to end, and before the end of the pattern, you're going to break out to the upside or break out to the downside. And whichever way we break, that is usually the direction of momentum, and you want to follow that momentum higher. That pattern, as of today, resolved to the upside. The GDX, the gold miner ETF, was up 3.5% today. We now have the previous high, April, May of 2023, in our sights. Actually, we're within the range of those days today. Actually, looks like made a new closing high today, just narrowly edging out that April peak from last year. So new 52-week high for the closing high for the GDX, and certainly suggests more upside potential for that key part of the market. Just to finish off, let's look at some other individual names that are on the move here. I want to highlight, names outside of the growth space. Here's Steris, STE, which is a medical equipment name in the healthcare sector. Look at this double bottoming pattern. This is what I feel like Microsoft investors want the chart of Microsoft to do, because we're in this similar range. Well, I'll look at Microsoft a little later. You'll find it's a very similar layout. We bounced off of support here, which is a retest of the November low, and now today we're gapping higher. I think this was an earnings name today, but gapping above moving average support, closing near the highs of the days. I think that opens up a return to the previous peak around 235. Breaking out of that base would be really encouraging, but price movement's strong. Momentum is strong with the RSI nearing that overbought condition. A lot of utility stocks look a lot like CEG, and this is a Constellation Energy making a new 52-week high again today. Look at the rally that you saw in the first quarter, and then it sort of stalled out here April and May. So while the major averages came off in early April, CEG just didn't lose much, right? It just didn't make any additional headway to the upside. It didn't lose any ground at all. Now we're resolving to the upside, and utilities, again, year to date have been one of the strongest. It may actually be one of the, maybe the strongest sector as I think about it. I'll have to look at check the tape on that one, but overall, and you know what? I have the tools available to me. Why don't I do it? So what I'm going to do is go to my chart lists, and I have a list of the 11 sector ETFs and the S&P as well. I can go to the performance tab. We can answer that question. We're sorting it in terms of year-to-date performance. Look at this. Utilities up 13.6% year-to-date, followed by energy up 13.5%. Then you come down to communication services, then financials, then industrials. Real estate is, at this point, the only S&P sector that is down on the year. Consumer discretionary slightly higher. Tesla struggling is certainly not helping that particular chart. And then healthcare third from the bottom. But look at that. Utilities now edging out energy and all the FANG sectors. Top performer year to date. You saw it there. So charts like CEG are good charts. They're breaking out. But again, after that recent pause and that breakout, that suggests there's much further upside potential. Look at the relative strength on the bottom, just consistently strong. Now, I highlighted the chart of Steris. I think charts like Microsoft, actually, I was thinking of the chart of Apple. That's not what I meant. Sorry. When I was comparing it, the chart of Steris looks like the chart of Apple here, right? Sort of this consolidation, clear resistance, clear support. Apple gapping higher, and for now holding its 200-day moving average. Today's the first up close since that gap higher on after earnings last Thursday. That was Friday's gap open, and then we closed lower. We kept closing near the lows of the day, but for now the 200-day holding, which is actually be a really interesting development for Apple. Microsoft not quite getting above the 50-day moving average. We're stalling out there. If that can get back above there, that would be very encouraging. That's kind of what Netflix has just done this week, finally getting above the 50-day moving average after gapping lower on earnings in recent weeks. Tesla continuing to go down, and while you've gapped higher, we gapped higher and then traded lower, right? So compared that to some of these names that we've observed where you gap higher and then continue to see further upside. The opposite for Tesla. We had a couple gaps here, but that last gap in late April being sold, and for now, once again, we're testing the 50-day moving average. Look at NVIDIA. This is another one. Down today while the S&P is up. So anytime you have a big update and it feels like everything's up, it's always interesting to look at what's down. Same thing like if you have a big distribution day, it feels like everything's down. What actually was in the green? I think that's always interesting to see the outliers, the counter trend moves. And while the short-term swing in NVIDIA has certainly been up, this definitely looks like the bear flag pattern that I don't think we have anymore in the S&P, but I think we still have here on NVIDIA. We break below the 50-day, we break below a trend line using those previous lows. All of a sudden it starts to look like a chart very much in a distribution phase. So I think NVIDIA still has something to prove with that recent break above the 50-day not quite holding. long enough. We'll see if it can hold through the rest of this week. That's it, folks, for our market recap. We're going to wrap the show here in a second, but just as a reminder, 2 quick announcements to make. Number one, we love your questions. We're going to do an all mailbag episode on Friday's show, and we would love to answer one of your questions on the air. Our email is thefinalbar@stockcharts.com. We're on the Twitter @finalbarsctv, and we're on YouTube. So make sure you go to the comment section below the video and drop your comment there. Also, I will be doing a webinar coming up this Tuesday, May 14th at 1 o'clock Eastern, 10 a.m. Pacific. We're going to talk about what are we talking about? Sell in May. We're going to talk about the sell in May phenomenon. There's a long-running market maxim called sell in May and go away. We'll look at the history of that seasonal tendency where May through October is the weaker 6 months of the year. We'll see how that's not really played out particularly well in recent history at times where May into June have actually been a little stronger than expected. But what sort of charts we'll be looking at, and we'll highlight 5 particular charts I would suggest you follow in May into June to track a potential bearish rotation following that classic seasonal trend. To sign up for that free event coming up next Tuesday, go to marketmisbehavior.com/sell in May. That's it for the show today, folks. Thanks so much for joining us every weekday after the close for the Final Bar. Don't forget to tune in on Friday's show. We'll do a special all mailbag edition where we answer some of the great questions you guys have been sending in. Have a great rest of your week. From everyone at Stock Charts TV, I'm Dave Keller. Be well, stay safe, have a great night.